What's up, everybody? Genix Dividend Investor here. In this episode, I'll tell you how I unexpectedly woke up in a hospital recovery room, how that experience pushed me to consider some changes to my dividend portfolio, changes I'd really like to get your feedback on. It got me thinking about whether my current stock allocation really lines up with my long-term goals as optimally as it should. Now hang with me while I explain what's going on, but you can always use the timestamps if you want to jump ahead. If you're new here, then I recommend you check out my recent videos as I show you my entire Fidelity portfolio that I've built up from scratch over 3 decades, and I also share my background and stuff like that. My older videos tell you about how beyond investing I'm also passionate about my family and friends, video games, movies, and working out, and that I've been a gamer and a gym rat for longer than I've been investing. So it surprised me and everyone close to me when about 2 decades ago I developed a bunch of health issues because I was always the guy who was eating right and staying healthy. But it turns out I inherited some health issues from my dad, and long story short, I've had multiple open heart surgeries and strokes, though you'd never know that today if you saw or talked to me in real life. So it's probably because of my fitness lifestyle that I was able to recover as I have. Now, one of my peculiar health issues is that every so often I get amnesia, usually for a few hours, and the doctors have no idea why this happens. I've talked with specialists all around the world about this issue, from guys at Oxford to expert neurologists and cardiologists in the States. I've tried changing tons of things to stop my memory episodes from happening, from diet to blah blah blah, and nothing has worked. I've worn medical devices to check my brain and heart to see if anything could help with the diagnosis, and I've had CAT scans, MRIs, electrocardiograms, and so forth, but nothing has yielded any new insights. However, something new occurred last week that had never happened before, which is that during one of my memory episodes, I passed out and slammed into some furniture. It left me with nasty bruises, including one near my eye socket, so I almost lost my eye. I don't really remember falling down, but I do remember waking up in the hospital with my wife and doctors by the bed. I thought we had just gotten there, but my wife told me we had been there all day. Apparently they put me through a battery of tests, all of which came up empty. And lying there with no answers, I kept thinking about what would happen if the outcome had been worse. Would my family have the income they needed from our investments if I were not around, especially if something big went wrong? My point in sharing all that is to quickly bring you up to speed on my realities, as well as to help explain why I may want to tweak things in my dividend portfolio. That whole experience made me take a hard look at my stocks, like how dependable the income is and if I frankly am using my capital as optimally as possible. So I'm thinking about selling my Apple position. It's actually my 8th smallest holding of the 28 tickers I own. I'm also considering trimming some of my ExxonMobil and Chevron positions and then moving most of that money into an income-focused ETF. Note, I did a video about high-yield dividend ETFs that I recommend you watch after this. Anyway, my health issues make passive income all the more important for me and my family, and my recent episode really puts a ticking clock on things. Now, a common observation people have when they see my portfolio is that I hold 2 non-classic dividend stocks with super low dividend yields in Microsoft and Apple, neither of which provides much passive income. And that's fair, but I've held onto those stocks primarily as growth enablers for my portfolio, since my other tickers tend to be less about big upside. But Microsoft and Apple were both averaging about 10% dividend hikes each year, so even though their current yield was low, I figured long-term their income growth and stock appreciation would be worth having. And then a few years ago, Apple stopped doing its large dividend hikes and started doing smaller ones, which wasn't what I hoped for. They also stopped performing as I expected. Like, I was excited for their Project Titan, i.e. their car project, but they seemingly scuttled it after working on it for years. They also disappointed me with how they fumbled AI relative to what other big tech companies have done. Now it's Apple, so I'm guessing they'll have some big stuff going on behind the scenes that they'll announce down the road, whether it's product innovation or acquisitions or something. All that could reinvigorate the stock, but it still put me off. Its growth trajectory and history of innovation are less compelling than they once were, and all that got me evaluating whether I should continue to lock my capital up in it given my life. I'm up over 450% of my Apple position, which is nice given I've only held it for a relatively short amount of time compared to my other tickers. I've previously showed you that my average cost basis per share of Apple is 30-something bucks. I'm also up big on both my oil tickers, so another factor I consider is what the tax impact would be of selling in my taxable account. Now, one positive thing is that even if I sell stocks with large capital gains in my taxable, I won't actually end up owing taxes because I've been carrying a long-term capital loss from a startup I invested in long ago that went belly up. Another thing to be aware of is that even if I sell out of my Apple position, I'd still own some of it both directly and indirectly. Basically, I also own some Apple in a kid's custodial account, which I officially own until they turn 18. But I don't count those shares whenever I talk about my portfolio. And note, I'm not selling any Apple in my kid's account because I think long-term it'll continue to appreciate. But for my needs, it's become less compelling. I also own some Apple in my income ETFs. For example, my Devo position, which is a little over 4% of my portfolio, has Apple as one of its larger tickers at around 5% of it. JEPQ, which is around 4.3% of my portfolio, also has Apple as one of its larger positions at around 6% of it. And then if I do get into another income ETF, I'd probably focus on either a NASDAQ or SP 500 one, both of which would have more tech than I currently have. So even if I did sell Apple directly, I imagine my overall Apple exposure would still be around 1% of my portfolio, which would make it around the same size as my small Starbucks position. The same thing is also true of my oil exposure. Like SCHD is 6.3% of my portfolio, and its top positions right now include Chevron and ConocoPhillips. I actually think oil will do fine for years to come, but very long term, like when I'm 6 feet under, I'm guessing it won't be as compelling for my kids as it was for me. Of course, that's probably also true for my SIN stocks. Anyway, a big thing to know is that I'm retired, and I wouldn't recommend income ETFs unless you understand their risks and issues and you really needed their passive income instead of total returns, which is what most young people should be focusing on. Another long-term goal I have is to slowly move into more ETFs from single stocks, so doing changes like this can push me in that direction. Now, my covered call income ETFs are currently around 10% of my portfolio, and if I did this change then there'd be around 15%, which is still quite conservative for a retired passive income person like me. I'd also like any new income ETF I'd get into to distribute non-destructive return of capital in my taxable account if possible. Return of capital, or ROC, refers to the part of a distribution that comes from your original investment rather than from actual income generated by the fund. A non-destructive ROC occurs when the ETF generates enough cash flow from its options, strategies, and dividends to support distributions without reducing the fund's overall value. In this case, the fund is returning capital in a way that's sustainable and tax efficient, simply lowering the investor's cost basis without triggering immediate tax liability. A destructive ROC happens when the ETF can't generate enough income from its option trades and such, and instead returns part of the investor's principal. This might involve selling portfolio assets to maintain payouts, which can reduce the fund's net asset value and limit future income potential. And while both forms of ROC lower the cost basis, a non-destructive ROC reflects a well-managed strategy, while a destructive ROC may indicate that distributions are being maintained at the expense of long-term performance. Or to say that differently, if I end up going with an ETF with the type of ROC I want, then I can avoid having to pay federal income taxes on it for many years. I'd also love to get some capital appreciation from the ETF, but that's secondary and not something most people focus on for these sorts of investments. With all that being said, one new ETF I'm considering going into is the Goldman Sachs NASDAQ 100 Premium Income ETF, aka GPIQ. This is a newer ETF Goldman started in late 2023 to compete with JP Morgan's successful income ETF JEPQ, even though Goldman's ETF is a bit different. It uses a dynamic covered call strategy, selling call options on 25% to 75% of its underlying holdings, which should help it generate a monthly income while allowing some upside participation when markets rise. My guess is it will yield around a 7% to 10% distribution under good circumstances, but it can fall during certain market conditions. It basically holds the same stocks as the NASDAQ 100, which means it holds around 100 tickers, including things like Nvidia, Microsoft, and Apple. So it seeks to give tech exposure with potentially lower volatility than its underlying index. I'd guess that in a flat or slightly down market, GPIQ will probably outperform the NASDAQ 100 because it keeps its option premiums, which can help cushion some downside. In a strongly rising market, I think GPIQ may underperform its benchmark because the fund's gains are capped at the strike price of the call options it sold. For example, if a stock held by the ETF jumps 20%, but the call was written at 5% above the current price, the ETF only gets that 5% plus the premium, not the full appreciation gain. So in that scenario, its distributions probably would be similar to what it was like before, but its overall total return of distributions plus capital appreciation would probably be significantly lower than that of a traditional, non-options based NASDAQ 100 ETF like QQQ. Then in short downturns or crashes, I'd guess that GPIQ will still probably decline, though I think less than its underlying index. Basically, the premiums collected from selling options are often not enough to fully protect the fund from a steep drop in the underlying stock prices. I'd also think that they'd unfortunately see a material drop in distribution income in a big crash, though perhaps not as steep as the market's decline. I mean, while implied volatility would initially spike, helping its payouts, my guess is that their management would be cautious and reduce the percentage of the portfolio covered by options, or sell options further out of the money, which should reduce the total premium income collected. And to maintain some level of distribution, GPIQ might have to rely on more destructive return of capital, which isn't a sustainable long-term source of income and would further shrink the fund's NAV. But so far my research indicates that its ROC has been non-destructive. I'd guesstimate that if the NASDAQ 100 drops by 25%, then GPIQ's distribution might fall by 10% to 25%, as the premiums collected, even if individually larger, are now applied to a much smaller portfolio. One approach I like to take when evaluating covered call ETFs is to assume a potential 50% payout cut as part of my risk planning, just in case something goes seriously wrong. And speaking of downside risks, one concern with GPIQ is that it's a relatively new ticker, so we don't have a track record of how it performs during a major market downturn. Yes, we can look at other options ETF to see how they've done, but I'd still love it if GPIQ had been around longer with more history we can review, even though past performance is never a guarantee of future performance. Another concern I have is that after a market crash, ETFs like GPIQ probably wouldn't fully participate in the subsequent market recovery, since by selling call options, they tend to cap their upside potential. This means the covered call ETFs can fall nearly as much as the market, but then fail to recover at the same pace. Therefore, while the covered call ETF strategy can help slightly reduce losses in a bear market, it doesn't provide significant downside protection and can cause the fund to underperform during a strong recovery. And that's part of why I'd not recommend things like GPIQ to the majority of people who want growth in their portfolios, but I think it's reasonable to consider it as a piece of people's income portfolios, as long as they understand the risks, shortcomings, and nuances. And note, it's got a 0.35% expense ratio, which is high compared to low-cost broad market ETFs, but is reasonable or even cheap compared to some options ETFs out there. Now, a common critique of income-focused ETFs is that they often deliver lower total returns compared to the broad index they track, and that observation is generally accurate. However, what these critiques sometimes miss is that investors in these funds usually aren't focused on maximizing total return. No, their priority is about generating reliable and consistent income. For many people, especially retirees or those who rely on their investments to cover living expenses, steady cash flow holds more value than the potential for higher long-term growth. Selling shares to create income requires making decisions about timing, navigating market volatility, giving up equity ownership, and managing emotions during downturns, not to mention having the knowledge and ability to actually execute the sales. Thus, receiving income directly through distributions simplifies the process and reduces stress. So if you can't understand why someone would give up some growth potential in exchange for regular income, it likely means you're not in a situation where passive income provides more peace of mind and goal enablement than capital appreciation. For many investors, that trade-off is not only acceptable, it's exactly what they're looking for. Anyway, there are lots of other income ETFs out there that might be worth considering, and different ones can make sense based on your goals, risk tolerances, etc. For example, QDVO is another compelling one to me. It's managed by Kevin Simpson and his crew, like my DVO and IDVO positions. I imagine it would have more capital appreciation than GPIQ averages, but it would probably also average less income, but still high, like maybe in the 6% to 9% range. It holds almost 50 tickers, with the largest positions being in tech stocks like I want to see. One downside for me is that QDVO's distributions aren't all ROC like I want. And note, I'm just touching on the very basics of these ETFs to keep this video from being too long, but obviously you need to dive deeper before ever investing. Anyway, I could also consider a more aggressive, and what I believe would be riskier ETF than something like QQQI, aka the NEOS Nasdaq 100 High Income ETF, which apparently won this year's Best New Active ETF on ETF.com. It's got a 0.68% expense ratio, which is getting up there, and doesn't have as well known of a company behind it as Goldman Sachs. I'm guessing it would probably have less appreciation than GPIQ or QDVO, though again, you tend not to invest in tickers like that for appreciation. It has a pretty interesting way to seemingly yield what I believe would be mostly non-destructive return of capital, at least if it operates as I think it does. But yeah, it does have a very high yield that so far it's been able to basically maintain, though I'd imagine it will have some hiccups at some point in the future. One reason QQQI looks a bit riskier to me is that it has to do with what I see as a more aggressive income strategy, which uses a call spread to generate high monthly income while still allowing for some upside participation. My guess is we would see more volatility and sensitivity to market swings, both in its stock price and distributions. Another one some people love is SPYI, which operates on the SP 500. For fun, I looked at the total returns of those tickers as compared to the SP 500, but since some of them are so new, it's not even a year's worth of data, so it's kinda not that useful. Still, you can see that SPYI returned 12.7%, the SP 500 returned 14.5%, GPIQ returned 18%, QDVO returned 24.5%, and QQQI returned 18.5%. Of course, any ticker can do super well over short periods of time like that, and what I want is long-term sustainability and ideally income growth and such. An interesting exercise would be to look at each of those ETFs' performance since inception and compare them to their underlying index. For example, here is SPYI's total return since inception, i.e. late 2022. Again, most people who invest in SPYI are doing it for income, not total returns, but I still think it's useful to see. It shows SPYI has returned about 47%, as compared to 59% for the SP 500 and 74% for the Nasdaq 100. And again, for all of these, remember it's been a tech bull market. But hey, it's also averaging something like an 11% yield paid out monthly, which is why retirees find it compelling. And if a market crash happened, I think all of them would have materially cut their payouts. And think about where the Nasdaq is right now. I mean, I feel it's way overpriced, and don't forget what happened during the dot-com crash. That's when the Nasdaq 100 fell over 80% from its peak during the tech slaughter of the dot-com bubble and didn't fully recover for something like 10 years. That's why it hurt people like me so much who were over-indexed in it. And for reference, the S&P 500 fell like 50% from its peak to trough in the dot-com crash, and the boring Dow stocks fell like 33%, which was part of why I moved more into dividend investing rather than speculative tech stocks. So do I think we're headed for a crash in the short term? I obviously don't know, and I wouldn't be surprised if AI continues pushing things up, though these days I'm hearing more and more that we seem to be headed for a recession. For example, literally as I was working on this section of the video, I saw this new Fortune article that says, the US economy is experiencing a noticeable slowdown in mid-2025 with sluggish domestic demand growth, muted job gains, and new tariff actions posed to impact both inflation and overall economic momentum. And yesterday I saw this warning from Moody's chief economist that the US economy is on the precipice of a recession, citing indicators from last week's economic data about stagnant consumer spending, contracting construction and manufacturing sectors, and projected employment declines. But the fact is that no one can accurately predict if we'll have a recession and what that will mean for the markets. Stock markets often fall before a recession, as investors tend to anticipate economic slowdowns. And recessions often mean bad stock markets, but again, no one knows what the future will bring. So is now a good time for me to be doing this? I mean, most tickers are quite expensive, so is it better to wait? Well, since I don't hold a lot of cash on the sidelines, it means I need to sell something if I want to buy something. So I consider now as a reasonable time to sell stocks that I feel are expensive or reasonably priced. And yes, I could always sell and then sit on that cash, wait for a crash, and then jump in, but I found that challenging to do, especially with ETFs. Heck, part of the reason I have a preference for quality dividend stocks is that they help me not worry about market crashes impacting my income too much. At least for my quality dividend companies. Sure, if my companies get too impacted, they can cut their divvy. But having a nice basket of stocks has historically helped shield me from that happening. And that's another reason why I like tickers like SCHD. It stands out to me because it combines a higher yield than the S&P 500 with a focus on mostly quality companies that have strong balance sheets, consistent profitability, and a history of paying and growing dividends. During recessions, that quality tilt can offer some protection since these companies are often better positioned to weather economic downturns without cutting their payouts. So while no investment is completely safe, SCHD's diversified basket helps reduce the risk of any one company impacting the overall income. SCHD also emphasizes dividend growth, which helps maintain and potentially increase income over time, even if markets are volatile. That pseudo-reliability is a big reason why I prefer funds like SCHD when thinking about long-term income and stability. But my largest position is in SCHD, so that's also why I'm considering moving a bit more into riskier CC ETFs. Covered call ETFs tend to be more sensitive to market volatility and are more susceptible to NAV erosion over time, another thing you gotta check. Thus, you have to really think about whether you're comfortable with the pros and cons and risks and issues of options ETFs. Everyone's situation is different, and things like risk tolerance, income needs, and investment goals all play a role in what you should do. And regardless, don't ever blindly follow and copy what I or any YouTuber is doing, and always do your own research, understand the risks, and make decisions that fit your plan. That being said, I'd really like to hear your thoughts. What do you think makes the most sense for me to do given all you've heard? Of course, ultimately I'll do what I think is best, but I like hearing other people's opinions and I'm open to changing where I'll go from here. My long-term members know that on average, I sell out of one ticker and buy one net new one per year. But that doesn't mean I do that every year. Now, one con to doing a change like this is that it will probably negatively impact my portfolio's growth and average weighted dividend CAGR, which means slower dividend growth overall. I expect Apple and Exxon and Chevron to continue to do raises for at least the next few years unless something really goes off the rails, so there are some trade-offs to get more passive income right now. Another thing I should mention is that if I sell some of my Apple and oil stocks, I'll probably keep $15,000 out to give a relative who is in need. I normally strive to avoid selling for cash, but sometimes I'll do that depending on if I feel someone needs it. This relative is someone who's helped me out a lot in life, although not financially, so it's nice to be able to help them in a way that they need it right now. Anyway, the hospital wake-up was more than just a health scare. It was a moment that showed me how important it is to build a big enough income stream that can keep supporting my family without needing me. Hopefully now you can better understand why I value passive income so much. It's given me not only time, which is one of my most valuable assets, but also peace of mind that income will keep flowing into my family even if I'm gone. I appreciate that assets like ETFs often mean I could spend less time thinking about my portfolio relative to single stocks, though covered call ETFs have more issues than broad market ones. Anyway, while right now we have enough income to cover our expenses, I still think it's prudent to give my wife and kids even more wiggle room in case things don't go as I hope. She would struggle to log into our portfolio and sell stocks for more income, even though I've created documentation for her to do that if needed. The final thing I want to mention is that an awesome gift my health stuff has given me is that it's really opened my eyes to how lucky I am to be alive. So was I unlucky that I passed out and smashed into the furniture, ending up in the hospital? Or was I lucky that I somehow managed to avoid having my eye pop out and instead only got a nasty bruise directly above my eye socket? Something to think about. I feel like you gotta appreciate every second you have because you never know what the next second will bring. Sure, it's easy to complain about your situation in life, but is it worth focusing on the bad? There's lots of crap that goes wrong in life, some big and some small. Like, hey, maybe your barista screwed up your Starbucks order again. Or maybe the traffic driving into work is driving you crazy. Maybe you're dealing with some really big life issues that cause you stress, and I get it, sometimes crappy stuff happens, and life's not always fair. But my 2 cents is to try not to dwell on the bad stuff, and instead focus on what is going right in your life, on what you do enjoy doing, on where you hope to drive your future. Be grateful that you woke up and that your future isn't written yet, and will probably be bright. Sometimes you gotta live like there's no tomorrow, and when things are looking down, then look up. That moment in the hospital reminded me that while we don't control what happens to us, we can still make intentional choices. And right now I'm choosing to align my investing with the things that truly matter. With that, I ask that if you appreciate me doing this video, then please show your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification, all of which really helps. Moving on, now I'd like to show my gratitude to subscribers who've left me really kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Money in Life TV, who has a YouTube channel with 95,000 subscribers that he quit posting on when he started his own accounting business a few years ago. Zoot7466, Max Rotor 1, SCHD Stan, and Dumpster Fire from Twitter. I'd also like to shout out multiple nice comments from Justin Hohenschel, multiple from Daniel Stusnick 6011, multiple from Annie Ang Yu, multiple from Roger Dandruff, and multiple from the Multiverse. Thanks folks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'd also like to pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.